Carvana stock might just be the perfect example of what happens when shareholders and market forces combine towards one common goal. Yes, folks, after being down more than 99% from its August 2021 highs, CVNA stock is now up 1,000% for the year 2023. Whether it be considered a meme stock or not, Carvana's resurrection is a pretty impressive story that most investors can learn quite a bit from. As one of the most hated unprofitable growth stocks of 2021, Carvana stock was basically the front paper for the destruction we saw in unprofitable companies. Higher interest rates, decade-low savings rates, and people spending less time at home after the pandemic hurt quite a lot of businesses. That resulted in the tech bubble 2.0 of 2021 and hurt businesses like Carvana the most as used car prices soared and then promptly collapsed. And although Carvana from a business standpoint still has a lot of hurdles to overcome in the form of cash flow and profitability, the resurrection of this business and the shift in sentiment is something many people can learn from and potentially overshadows exactly what we can experience in the impending bull market. I said this time and time again over the past 2 years, but price tends to leave many people in a negative bias. And just like we saw the bear market skew up most retail investors towards the bearish side, we're starting to see that now in the opposite direction with people flipping to the upside. And the reality is this kind of situation can happen to any company that is publicly traded, even one that you potentially own in your portfolio. And as for how exactly that could take place, well, that is exactly what I want to explain and decipher in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. First things first, folks, we need to understand Carvana's debt dilemma that has sent its shares up more than 30% in one trading day and resulted in a year-to-date return of more than 1,000%. It'd be a severe understatement to say that many short sellers have been burnt on this stock. At a short interest per float of more than 45%, this company was officially one of the most shorted stocks, with short sellers and firms jumping on the bandwagon since the start of the year. And guess what? From a macroeconomic standpoint, their theses made quite a lot of sense. But as we all know and have figured out, markets tend to always be forward-looking. This is a term I like to call leading indicator. And Carvana has undoubtedly become the epitome of what leading indicators can result in for valuations that get stretched too much to the downside. Carvana had a net loss of $1.4 billion in 2022 with a debt load of more than $7 billion after it completed the acquisition of a company called Adisa, which just so happens to be the largest auction company in North America. That acquisition occurred in May of 2022 and was a very bullish case for the company because it allowed Carvana to outcompete competitors like Shift Technologies, Cars.com, and CarMax towards having inventory access to some of the cheapest and lowest mileage vehicles in America. And these leading indicators compounded at a time when inflation was starting to fall aggressively, especially as seen by the CPI data for June. All this meant that lower and stable interest rates were on the horizon, and Carvana's cheap valuation potentially getting a little bit overextended. This was at a time when many people expected Carvana to file for Chapter 11 bankruptcy and not be able to raise any more money from the public markets. But as we've just learned, folks, the exact opposite has happened. Carvana has officially raised more than $1 billion from an at-the-market stock offering, restructured more than $2 billion in debt, and lowered its monthly payment on interest by more than 50%. The company is now potentially going to make it out alive of this bear market, which is reinstilling the confidence in many equity investors and potentially creating yet another opportunity for trades and growth in the near future. and here's exactly why. You see, folks, the way that Carvana has approached this new restructuring deal is purely genius. After having reported second quarter earnings that topped most analyst estimates and reporting yet another quarterly loss, Carvana decided that with its partners by the name of Apollo Global Management, PIMCO, and Ares, which are some of the key creditors that were backing Carvana's IPO, that they're going to erase more than 87% of the company's outstanding 2025 and 2027 notes. For those that don't know, a note is essentially a form of bond that is issued by Carvana to investors who want to provide the company with capital. Bonds are typically number one priority when it comes to getting paid back after equity, which is why when a company goes bankrupt, investors and stocks typically tend to get completely wiped out. The company's assets get liquidated into pure cash, and those key creditors are the ones that get paid back their money if the company has enough available. Investors tend to always get zero. On top of that, folks, not only is Carvana now issuing 35 million new shares to take advantage of the recent stock run, but it is also using its Adisa assets, which is the massive company it acquired in 2022, to create a new note offering for those same investors. Instead of it being an unsecured note, now it is a secured note, which allows Carvana to pay much lower interest on its debt. And the reason for that is because Carvana is backing those debts with its Adisa assets. This means that Carvana can now pitch equity investors on the lower financial risk that is inherent from its less total debt, as well as its lower cash interest requirements on an annual basis. This essentially provides Carvana a lifeline for the short term to navigate the headwinds and convince a new investor pool to fund the business. Because obviously, folks, the old investor pool of the past 24 months has been burned severely. Bondholders now essentially have a bigger control of the overall investment group around Carvana, which ensures more capital structure and safety around key assets. What this entire ordeal goes to show is that assets can indeed be used to restructure debts for companies that are strapped with low liquidity. Carvana was one of the most unprofitable businesses of 2022, yet they are still on track to potentially come out of this bear market alive. The stock, although down 99% at one point, is now up more than 1,000%. Which really should add to general investor confidence when it comes to growth and potentially unprofitable stocks. So, what do you guys think? Is Carvana a one-stop shop, or could there be more stories in the market of growth stocks turning around from their bear market lows of 2022? As usual, folks, thank you very much for watching. Let me know your thoughts, and I'll catch you guys in the next one. Take care.